Hello, chart watchers, and welcome to this Thursday, July 26th Market Watchers live show with your hosts, Tom Bowley and Aaron Swinlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, taking a look at the market today, we've got quite a bit of earnings news to try to digest. The Dow Jones Industrial Average currently up 155 points. The S&P 500, after opening lower, now down just 2.5 points. NASDAQ getting hit hard from Facebook. We'll talk about that in a bit. The NASDAQ currently down 54 points. Russell 2000 on a relative basis, a little bit under fire today, or on fire, up 13 points back near 1,700 and not far from its breakout to an all-time high. 10-year Treasury yield up almost 3 basis points, sitting at 2.96%. Volatility continues to move lower and lower, currently down at that 12 level, just above. Utilities performing pretty well today, up nearly 1%. Same goes for consumer staples. Unfortunately, these are two defensive groups. And while them leading for a couple of days isn't a bad thing, we do want to keep an eye on that. Technology, after gapping down earlier today, is still down quite a bit, down about 1.25%. And the reason, Facebook getting absolutely crushed today, lowering some revenue guidance and some of their operating margins. We'll talk a little bit more about Facebook in a bit. But if you think Facebook got hit hard, Nielsen, NLSN, got hit even harder. They had a lot of bad news with their earnings report. We'll talk about Nielsen as well. On the flip side, AMD, leading the semiconductors higher, having a very strong report. And with that, Aaron, it is almost the end of another trading week. Lots of earnings reports out this week. A lot more to go next week. Market trying to digest it all.
Oh, definitely. And I have to say, if nobody understood the meaning of a price shock, I think a lot of people understand it today. So yeah, that's really deep. That's a really deep decline. And I suppose that really does present a good argument for you that you always say, don't hold into earnings. Yeah. A lot of people are probably wishing that now today.
Yeah, I'm sure there are a lot of folks holding Facebook into earnings. And for the most part, I think it's been a good thing. But they actually missed their revenues for the first time in over 3 years, their quarterly revenue target. And a lot of bad news in there. I'll talk about some of those fundamental numbers in just a bit. But yeah, not good there. And numbers the gaps are all over the place. I mean, we've got a lot of pretty strong action, as I talked about, the Dow being up 155 points today, and small caps starting to rebound, I think is a good thing as well.
Yes.
But there's plenty of bad news out there as well.
Yeah, it's very interesting. There's for sure. So many earnings reports to go, though. This is getting exciting. We'll have to see what comes up sooner. Which ones are you looking toward?
Apple,
yes.
Apple, we had that poll last week about, Apple potentially being the first company to reach $1 trillion in market cap. They weren't far from it. They're continuing to move higher. They get a little bit of a gap up. It wouldn't take a whole lot. They could be a $1 trillion company next week.
Yep, that'll be very interesting. I'm with you.
Okay, well, we got a lot on our plate for today. We do have Dan Russo in with us today. Dan, how are you doing this morning?
Doing well, Tom. Doing well, Aaron. Thanks for having me back.
Always a pleasure. I know you're going to be in here talking about opportunities. How closely do you follow the earnings? I mean, do you try to take advantage of earnings reports, or is it more of a bigger picture look at stocks for you?
It tends to be bigger picture. As you know, everything's kind of based on our model and our system for rating stocks. So I don't generally like to make earnings plays per se, but if I own a stock that we rank bullishly or with a very bullish rating, I'll tend to hold on to it through earnings, and vice versa, on the sell side or the short side. Maybe if a name turns bearish in front of earnings, I might sell it. But earnings specific plays I kind of find are tough because, it's not enough to get the quarter right. You have to get guidance right, and you have to get investor positioning right. And that is a really, really tough game to play. A lot of my former clients, hedge fund managers, institutional investors at mutual funds, they don't get it. It's a coin flip on if they get it right. So I try not to play that game.
Well, a lot of people got Facebook wrong because the stock was heading up into earnings, making it look like it was a play on an earnings beat, perhaps, and maybe some raised guidance. But Facebook really flipped everybody on that one. But we're going to get back to you here in about 15 minutes, if that's all right, Dan. Stick around and
looking forward to it.
Sure, everybody wants to hear your update there. So, okay, Aaron, I'm going to let you take it away, the upcoming schedule, the agenda, and then we'll get things started here.
Yes, jam-packed as always. We're getting ready to start that power charting with Bruce and Roman, 3 p.m. Eastern. And you can see Mary Ellen is going to be in here next week as a guest host while I am out celebrating my 1-year anniversary. August seasonality, you're going to take that on the 31st, Tom. I know we look forward to that for what's going to happen in August. And then finally, of course, we have ChartCon. Can't forget that. I know I haven't, because another deadline is fast approaching for us.
Yes, it is.
Yes, today's agenda, Dan Russo, as you just heard, is here from Chaikin Analytics. Our first symbol for the 10 and 10 to 1 is going to be Williams-Sonoma, WSM. And then we're going to finish off with our segment called Watchlist. And you can see what we have currently on the list and what we're keeping an eye on. All right, Tom, I know there are plenty of headlines, technical headlines, so I'm going to let you take it away.
Sounds good. We've got a few economic reports out this morning. June durable goods rose 1%. Market was expecting 3.2%, but this is a pretty volatile reading. I try not to look at it from month to month. It'll drive you crazy. But June durable goods ex transport, so when you strip out the volatile transports, it rose 0.4%. And the market was looking for a 0.5% rise. So just a slight miss there. Initial jobless claims came in a little better than expected, 217,000 versus 219,000. June wholesale inventories were flat. Market was expecting a rise of 0.3%. And all of that has translated into a 10-year Treasury yield. Here we go, 10-year Treasury yield, which is now currently up almost 3 basis points, challenging the high from earlier this week on Monday when we got up to about 2.97%. And just beneath the double top we saw in the first and second weeks of June, near 3%. A break above 3%, and I think we're going to get it. I think we are starting to trend higher again. You can see the PPO on this daily chart has now moved into positive territory. That's telling us that the momentum is accelerating to the upside on the 10-year Treasury yield. So I think eventually we are going to go through this 3% and make another run at that May high at 3.11%. That should be good news for many of the financial stocks that tend to do better as interest rates are rising. I did want to mention on the NDX here, the NASDAQ, of course, getting hit the hardest because of Facebook. But really, it's not that bad considering the report that came out with Facebook. You would think, and I talk a lot about the VIX and the VXN, and when they're up high and the market's nervous, if we got a report like this on Facebook, I think the market would get absolutely slammed. But because we are looking at a volatility index, which is down around 12, and the VIX and the VXN is much lower, market tends to handle bad news like this much better. And this is more of an isolated thing with Facebook and maybe some of the other internet stocks than it is an overall NASDAQ 100 problem. So the NDX today, you can see it is down 81, down about 1%. But a lot of this is attributable to the weakness in Facebook. There are plenty of areas within the NASDAQ that continue to perform pretty well. From a support perspective on the NDX, what I would continue to watch, we broke out at 7,300. That was the high back in June. So we've been holding that on pullbacks. You've got the rising 20-day moving average at 7,315. So I think as long as we stay above that number, we're completely fine in the short term. And I would probably even go a step further and say from a maybe a little bit more of an intermediate term perspective, the high that we saw back in April, and then these highs right in here coming through intersect maybe at about 71.75, and the 50-day moving average is at 71.62. So these are a couple of key areas I would be watching on the NDX. As long as we hold that, I'm not overly concerned here with the action in the market. Let's talk now about Facebook, because this was a mess of a report. Facebook, first of all, they are down roughly $100 billion in market capitalization today. Think about that. $100 billion they've lost in market cap today from this announcement. They've projected slower revenue growth rates going forward. As I mentioned earlier, they missed their revenue estimate for the first time since the first quarter of 2015. So that was a shocker for everyone. They guided their Q3 and Q4 revenue lower, guided operating margins down. Get this. Their operating margins, they're saying, are going to trend towards the mid 30% range. Consensus estimates for 2018 and 2019 were 45% and 44%. That is not slightly moving your margins down. That is a massive movement in the operating margin, and I think completely changes the valuation. And I think that's what traders are telling us. That's why the stock is down as much as it is. I think this is a game changer for Facebook. I really do. I think that the pullback, sometimes it's an opportunity. I'm not so sure this one's an opportunity. They broke out above about 108 or 190, and now the stock is trading down at 178. I mean, perhaps we'll see a Netflix kind of recovery by the end of the day, but I wouldn't be holding my breath on this one. I think that Facebook is going to continue to trend lower. We might get a little bounce off of this, some bottom feeding, but I think eventually, before we go back up above that 20-week moving average, I'll be surprised if we don't hit 150, 160 before then. And that could establish a very significant neckline that I would be watching on Facebook. Because a lot of times when you start lowering margin guidance and so forth, you have a lot of future adjustments as well. So that's something to keep in mind. Nielsen. Good news for Facebook is that Nielsen was the worst performer in the S&P 500. They actually topped Facebook's decline. Nielsen down over 25%. CEO Mitch Barnes retiring at the end of the year. They lowered guidance substantially. Fiscal year 18 guidance, 95 cents to $1 versus $1.50 to $1.56. I mean, that is a massive lowering of guidance. Revenues now expected to decline 1%. The market was expecting a 3% increase. And free cash flow, consensus was $800 million. They lowered it to $550 to $575 million. NLSN getting absolutely crushed. A couple of industry groups real quick. We got healthcare providers trying to make a breakout here. This is a strong group, and it is trying to make another breakout worth keeping an eye on. I'm not going to pull it up, but broadcasting and entertainment doing well today on the heels of Disney, which is trying to make a breakout. You can see it's got these tails, 114, 115. And then finally, the semiconductors coming to life. I mentioned earlier that this decline in Facebook really isn't impacting a lot of areas of technology. It's really just the internet stocks. And here's an example. Semiconductors actually up almost 1% today, trying to get through 35.50, which would be a big breakout. And Aaron, I know there's a pretty significant company within semiconductors that reported pretty solid results leading this charge. So I'm going to let you take it away.
Yep. And of course, that would be AMD. So let's take a peek at that chart. All right. Yeah, I took a look, obviously having a great day, up over 13% right now on that positive earnings report. The revenues were $1.76 billion versus $1.72 billion, which was the market estimates. Earnings per share, 14 cents versus 13 cents. And they did, however, lower their Q3 revenue guidance, but doesn't seem to be bothering anybody that much. I look at this chart and I'm seeing a possible reverse divergence here. You've got declining bottoms and you have rising bottoms, and that's considered a reverse divergence. And we get the breakout, and I think you could even make a case that we were shaping up a ascending triangle, and we did get that breakout from that triangle. And height of the triangle would be roughly $14.50 to $17, about $3. So upside potential around $20 for AMD. I think AMD is looking really good right now. We did have some other earnings reports, though, that I'm going to go ahead and talk about. Align Technology. Align had, they hit revenue and earnings per share, $490.3 million versus $472.1 million. Earnings per share, $1.30 versus $1.09. And they did lower their Q3 earnings per share guidance. So I think that would probably explain this 4 1/3% drop right now. Notice that the PMO, it looked like it was going to make that move. We had the breakout over this previous top. really look like a good opportunity here. But, now we've got that PMO sell signal. We got the whipsaw. It looks like it ended up turning into somewhat of a bear trap, but, really more than likely this move on earnings. So we'll have to see how it all shakes out. Citrix Systems also reported good earnings. Revenues, $742.4 million versus $716.3 million. And earnings per share, $1.28 versus $1.20. And they did raise their guidance for Q3 revenues, earnings per share, and fiscal year 18 revenues and earnings per share. It looks good. We're looking good. And obviously investors think so as well. We had a bit of a fake out here where we ended up, again, I think in this case, it was more of another bear trap here, trap some of these bears as we saw that decline, and a drop below that previous area of support / resistance. But now looking pretty good, I have to say, up 3.5%, and it has pulled back since the intraday high at about, let's see where we're at, 113.07. The high was 116.82. So this could be a pretty good opportunity here on Citrix Systems. And let's see, I wanted to look at F5, and actually Chip posted on our Slack that they're getting ready to sack about 230 people in Seattle area. So interesting look here. F5 revenues $542.2 million versus $540.6. Earnings per share $2.44 versus $2.39. And they did raise their Q3 earnings per share guidance. So it sounds like, based on the article that I saw regarding that, job losses, it's more of a kind of a refocus of what they do and what they plan on doing in the future. I would be a little concerned here, though. I've got a declining PMO. The PMO tops are in line with the PMO tops here on F5 here on that declining tops trend line. You can see we hit that trend line, and then we've pulled back, but we're holding that support area, so I'd watch that very closely. But we could be looking at a descending triangle situation here, and I would be a little bit concerned that we might get that breakdown. And I don't know if those job losses or any kind of information that came out of that particular article could end up foreshadowing something coming up, but I see a really strong area of support down here at about 155. Keep an eye on this one. Let's go ahead and look at some of the upgrades and downgrades. And actually today we're only looking at downgrades. And here is one, 3D Systems, and I've marked up these charts already. I see a double top here. And interestingly, when you look at the support down here at $11, it does line up close to the same area over here between what was support and then resistance, support. So I would be looking for a drop. It could go down all the way to $11 here off that double top. If you measure the pattern on the left end here, that would put us down right about that support line. So keep an eye on that one. ELF Beauty, this one's ugly. I went ahead and looked at the weekly chart on this one. It doesn't get any better. We're lower than where their IPO was. So I would definitely not touch that with a 10-foot pole. Gilead, we've got a rising trend channel. Yeah.
I was just going to say, did you just rename them Elf Beauty to Elf Ugly?
Yeah, there you go. I knew you had to throw that one in there. But yeah, it is ugly right now. Rising trend channel here for Gilead Sciences. I think this one looks pretty good at the moment. We are getting a bit overbought on that PMO, and we are seeing a little bit of a descent on the scooter. This one, I think, one to watch. I wouldn't be looking for resistance until we hit that like 81.50 area. Just two more real quick, and then I'll bring you in, Dan. I pulled this chart up, and I thought, oh my goodness, what am I going to do with this? I can't read it. Great for the log scale here, and that does help. But still, you can see really hurting here. We take it to a weekly picture. It doesn't get any better, guys. This is even worse than Elf Beauty. Can even put this on a monthly, And there you go. This is just, we're looking at very low lows, and I would just expect this one to keep going. Skechers also downgraded today, but making a move back up anyway. We have 1/3% rise, but I'm on a PMO sell signal after this gap. We could be in the process of getting ready to close it though, so maybe one to watch, and wait until we see some improvement here. All right, Dan, I'm going to bring you in. I know you have lots to talk about. I don't want to take up all your time.
Oh, that's great, Aaron. Thanks. No, I was really enjoyed listening to what you had to say, and it's kind of interesting because Tom was asking about earnings earlier, and it's really hard to trade earnings. You see, stocks, you see companies beat estimates and move higher. You see companies miss estimates and move higher, and vice versa. So, like I was saying, it's very hard to get all aspects of the earnings trade right, to get the quarter right, to get the guidance right, to get positioning and sentiment right is very difficult. And I think that around this time, you get a lot of headlines, a lot of emotions kind of take over when, Facebook is a very over-owned name. I mean, there are people legitimately ripping their hair out today with the move in that stock. I mean, think about who do you know that does not own Facebook? In fairness, I don't. But it's a tough time to trade because it really does play on your emotions, and you're kind of bombarded with information around earnings as well, whether you follow names on Twitter or, in the traditional media. So it's tough. So for me, and when Tom asked me, how I trade around earnings, the short answer is I don't. I just kind of stick to my process for finding ideas. And, I've been on the show before, and Mark Chaikin's been on the show, and, working for somebody like Mark is obviously amazing. He's a legend, and, somebody who has indicators named after him, to get to work with that person every day and pick his brain for ideas is always helpful. And he just kind of reiterates the same thing. I ask him sometimes, like, what do you think about Facebook in front of earnings? He's like, what does the power gauge say? What does everything line up? What does your process tell you? So that's kind of going to be the crux of what I'm going to talk about today, is using a repeatable process. I like to say it's a simple and repeatable process to kind of improve your trading and investment performance. So just a quick about me. I am a chartered market technician, and I've been on the street for 18 years. I am one of the co-chairs of the New York chapter of the CMT Association. I also help them out by grading level 3 exams. It's a 3-part exam that we have to take, similar to the CFA, but for technical analysis. And if anybody's ever interested in sitting for the exam or looking at the materials, definitely let me know. I can put you in contact with the right people, but bear in mind, I also grade level 3, and I'm a tough grader. And I, for the past 10 years prior to my role at Chaikin Analytics, I was on the sell side for an institutional sales and trading desk, covering large institutional investors, hedge funds, mutual funds, pension funds all around the country. A lot of them are household names that you've probably heard of. So because I spent 10 years covering those types of investors, I believe this: fundamentals drive the market. Now, I'm a technician. I'm a technician at heart. I think that technicals combined with fundamentals really, really give you an edge, because while fundamentals drive the market, emotions drive the market to extremes. And Facebook is a great example today. The stock is, $100 billion in market cap. Basically, I saw somebody tweeted out that Facebook lost 4 Twitters today, which is pretty amazing. If you think about it, is that an overreaction? It could be. Only time will tell. Stock kind of, for me, the level in Facebook is in the 155 to 170 area. I think if we hold above that and stabilize, it makes sense to do some work. And this could be an instance where emotions drove Facebook to an extreme, but you have to combine the two, right? The fundamental picture, definitely, Tom, you alluded to this. The fundamental picture changed drastically for Facebook. And what's amazing is most companies would go crazy for 30% plus operating margins. Facebook is being taken to the woodshed because they're going down to that level. And it just goes to show you how hard it is to get those fundamentals right and to get investor sentiment right. Because 30% operating margins, those are considered the greatest companies on earth have 30% operating margins, and Facebook's being punished for going to that level. So fundamentals are going to drive the stock, but emotions may have taken it too far. So we like to combine the two. The problem with fundamentals is you are just bombarded with information. You know, as the day goes on, or late last night, sell side analysts were, you know, typing up their notes and updating their models on Facebook. They were doing calls with management and just being bombarded with different metrics. And then they were publishing all those research notes. And then the news media picks up coverage of those research notes, and they're telling you what Goldman has to say about Facebook and what Morgan Stanley has to say about Facebook and who upgraded Facebook or who downgraded Facebook on the moves. And it's too much. I mean, there are guys who sit at hedge funds and women who sit at hedge funds and mutual funds, and all they do all day long is try to process this information into charts and models. And we do that for you with our power gauge. You know, it helps you kind of know where a stock is headed. It's clear. It's a tested summary of a stock's potential. Basically, Mark Chaikin, over a 50-year career, has distilled down the 20 factors that most impact stock price. And I have them here on the screen. They fall into 4 buckets: financials, earnings, technicals, and experts, right? And each of those buckets has 5 sub-factors within them to get to the 20-factor model. What's amazing here is that Mark Chaikin, a known technician on the street, has technical indicators named after him, built this model. It's 85% fundamental, right? It's only 15% on the technical side. So that's amazing. So, and like I said, we don't, that deluge of information, we cut through all that clutter. You know, the screens of, you know, dividend yields and EPS and, you know, income statements and balance sheets and cash flow statements that institutional investors are going through. We've brought all that information into this power gauge to rank stocks from very bullish to very bearish, with neutral in between. And like I said, it's a proven model. So this is some data back to the beginning of 1999, and it runs until the end of 2017, and it shows you the performance of each of our rankings. So our very bullish stocks over that time frame, and this is both back tested and out of sample data, over on an annual basis, our very bullish stocks return about 20%. Our bullish stocks 12%. The average stock in the Russell 3000 over that time frame returned 9%. And on a cap weighted basis, the Russell 3000 returned 6%. So you can see the massive outperformance by our very bullish stocks and our bullish stocks. But what's also amazing is look at the underperformance by our very bearish stocks. In an environment where the average stock went up 9% and on a cap weighted basis went up 6%, our very bearish stocks, they barely went up. They went up 1%. So, this is, call it 800 or 500 basis points of annual underperformance. For me, I write a daily note for our subscribers and for our clients. I have to pick a stock every day. And actually, we'll go through my stock pick for today a little bit later on. But if I'm looking for long ideas, obviously I want to be looking here and here. And when I'm looking for short ideas, I kind of isolate it to the very bearish bucket, just given this performance. The statistics don't lie. Like I said, this is back tested and out of sample, which is important because back test can be fitted, out of sample data, obviously not. And even in 2015, which, the Russell 3000 was down about 1%, but the average stock was down close to 8%. You had a bear market in energy stocks. Look at the performance of our very bearish stocks. The power gauge not only tells you what to buy, but it tells you what to avoid and what to sell short if you do in fact short stocks. Our very bearish stocks on average were down 17%, and our bearish stocks were down 12%. So in an environment where the average stock declined, about 8%, you have massive underperformance by this bucket and massive outperformance by our bullish and very bullish stocks. So again, even in an environment where the market's heading lower and the average stock is heading lower, having that power gauge kind of really helps you be in the right stocks from a performance standpoint. So it gives you, we like to say, a directional edge. It combines the fundamentals and the technicals into a quantitative model. Our full platform has some signals for entries and exits, and I use those when I'm looking for long and short ideas for our clients. And it, while not specifically designed to trade around earnings, it can help you during earnings season, and I have a really good example of that in here. So just kind of real quick, how I'm viewing the market these days. My view of the market has not changed since the last time I was on the show. I still view what's going on as a consolidation within the context of a secular uptrend. you want to maybe call this consolidation an ascending triangle that we've just broken from with the move through 280 on the SPY. I think we could have some trouble here in the 285 to 287 level. That would take us back to the highs. And the reason I say that is because we have a proprietary indicator that we use to measure overbought and oversold conditions. And it's kind of like RSI, except it's designed to be overbought and oversold, even in a sideways market, like you can see here. So it's a little bit more sensitive, or I should say a lot more sensitive than the RSI. So we're currently overbought with this breakout. So I want to see how we react here, especially in light of what happened with Facebook. But Tom, to your point, the market's actually holding up pretty well. Our money flow indicator, which is available to users of stock charts, as you guys all know, has been bullish. So my intermediate term view of the market has not changed. I think consolidation within a secular uptrend that ultimately resolves to the upside. But we're coming into the part of the year where it's seasonally a little more dicey in the August-September timeframe. So I don't know if we get there now, but obviously my bigger picture view hasn't changed. And if we do break out, I would obviously become more bullish with that. You can see this is a unique feature that we have. We look at all of the main sectors based on their power bars. So this tells us how many stocks in each of these sectors has a bullish or very bullish rating, how many are neutral, and how many have a bearish or very bearish rating. And this tends to be predictive going out 3 to 6 months. So I know when I'm looking for long ideas, these are the 4 groups where I'm looking. They have a bullish power bar ratio, and they're outperforming, or their ratio is better than the S&P 500's ratio, right? So these are the 4 sectors of the market where I'm finding most of my long ideas right now. And the converse is true as well, right? Real estate, staples, and discretionary, all with bearish power bar ratios, underperforming the market. So when I'm looking for short ideas, I'm looking down here. I'm looking for stocks in those sectors, and in particular within the weakest industries in those sectors on a daily basis. And I know that Stock Charts has functionality to look at how the different sectors are trending. And what I would say, whatever your process is, it doesn't have to explicitly mimic mine. You want to look for the strongest stocks in the strongest industries in the strongest sectors for your long ideas, and the weakest stocks in the weakest industries of the weakest sectors for your short ideas. And for us, what we buy stocks that have a bullish power gauge rating, that are outperforming the market, and that have positive Chaikin and money flow. And an example of that is Macy's back in the April timeframe, which is the yellow arrow that was on the screen. When we look at the chart, we start at the bottom. This ribbon tells us where the power gauge has been over the past 12 months, and you could tell at the time it was on a bullish rating. That's the green down here. The next, moving up the chart, is how the stock has been performing relative to the SPY, and you can see the intense outperformance of Macy's. It began at the beginning of the year, right around the holidays last year, when everybody left retail for dead, when everybody told you that Amazon was going to put retailers out of business. That's right when the retailers started to outperform. So that's pretty interesting to me. I unfortunately, I didn't join Chaikin until the March timeframe, but this was one of the first ideas that I called out for our clients. And I called it out here when it became oversold, but money flow went positive. And it was a bullish stock that was outperforming the market, and it, subsequently, ticked up, pulled back in, and then positive earnings surprise, and the stock was off to the races. At $28, I called this out. It's trading. This chart is as of today. It's trading at $40 today. So that's kind of my process, right? At the time, retail was doing well within consumer discretionary, which at that time was doing well, and then everything else set up. It was a bullish stock which was outperforming the market. We call it our dynamic duo. When the market and our model are in agreement, that is a powerful, powerful signal. But what's interesting here is you can replicate a lot of what I do in stockcharts.com using money flow and Scooter, but unfortunately you don't have the power gauge to go off of, and the power gauge is where everything starts for me. But here's that exact same trade setup. This is the 1-year chart of Macy's. You can see the stock pulled back to the 50-day moving average, but look what you can use Scooter to replicate our relative strength. This Macy's ticked up in March to over 90 and pretty much stayed there. So this was a stock that was outperforming the market. Money flow, when money flow ticked positive, you had to pull back to support at a rising 50-day moving average. It was a great opportunity to kind of replicate what I do on a daily basis. If you had seen this trade, here's the gap up following earnings, and off to the races. Even about to make a new high here today, over $40. I do the exact same thing, just in reverse on the sell side. I look for bearish or very bearish power gauge stocks that are underperforming the market and that have weak Chaikin money flow, right? And here's an example, and this happened to be one that was right in front of earnings, but Philip Morris was already in a downtrend, right? The power gauge down here tells us it already had a bearish rating. It had been massively underperforming the market back in late April or early April when I first called it out as a short idea. So I didn't call it out specifically as a play on earnings. Let's get short Philip Morris in front of earnings. It was just my process, right? We had a very bearish stock that was underperforming the market, that became overbought based on our indicator. And if you're using stock charts, you can kind of use the overbought, oversold indicator that you prefer. Again, it's your process, but you can use Chaikin money flow, and you could see that institutions were just dumping this stock. I mean, look at the intensity of this bearish money flow. It tripped an overbought sell signal in our model. So I called it out as a short idea on a Monday morning. They reported earnings on Thursday, and you see the big gap down. And what's amazing to me is that they reported earnings again for the second quarter about a week ago. Stock gap down and reversed. It's done nothing but go higher. And I saw 3 sell-side analysts downgrade the stock here. So again, that's those fundamental guys getting deluged with information that's all coming at them, and it's all bearish, and it's all bearish. But had you been using a technical overlay, you could have seen that now is not the time to be downgrading Philip Morris. In fact, it still has a very bearish rating. It's still a weak trend and a weak market, but look at money flow. Institutions are starting to return to this stock. I think the sell side is going to prove to have gotten this wrong. They were late to the party on the downgrade. Our model was there the entire time. We had opportunities to sell it along the way, and now the fundamental analysts are starting to downgrade it. It just doesn't make any sense to me. And here it is. In stock charts, right? The scooter had been weak the whole way. I mean, it's been declining, kind of, and then predominantly was under 30, slight uptick, but money flow was massively bearish as we kind of, tested the declining 50-day moving average. And here's that gap down on earnings and continued to move lower. And then here's where the downgrades have. Look at the candles. Look at these. If you're a candlestick person, these are massively bullish candles here, a key reversal, and then another really bullish candle here, open at the low, close at the high. This is where the sell side is downgrading the stock. Again, doesn't make sense. Could be too early to tell. As I said, our rating is still bearish. You don't know that if you're just using stock charts, but our rating is still bearish. But I think the sell side analysts they missed the boat on this one. So those are 2 examples. I wanted to actually show you within stock charts 2 that I actually have in play currently. Remember we looked at the sectors and we saw that financials was towards the top of the list. And if you look within financials, insurance is actually doing really well. It's actually based on those power bars, insurance is the #1 subsector of the market that we're looking at right now based on the power bar ratio. So my idea for today was a long idea on Assurant, ticker symbol AIZ. It has a bullish Chaikin power gauge, right? And you can see it here. The scooter, this is pretty bullish. Is 87 this morning when I put these slides together. You can see the Chaikin money flow has been predominantly bullish since the March timeframe. Kind of moved up and through. If you look at a 2-year chart, you can see that there's resistance back at 105. We broke through that, and now we're consolidating just above it. I think that this is a compelling trade on the long side. This is a 50-day moving average. It's moving higher. I think that we're kind of flagging here, and I think ultimately this is going to set up to break to the upside. You do have support at $105. I think you actually I highlighted in my note today. I think you actually have upside to about 120. So you've $3 of downside for $12 of upside. I'll take that trade. And here's one that I have in motion, and this is an emotional stock. This is a bifurcating stock. It's Tesla. I mean, if you're on Twitter, you can see the Twitter wars between the bulls and the bears on Tesla. People are dogmatic in their view. I am not. I put this out as a short idea on Friday morning when the stock was at $317 because our model, first and foremost, has a very bearish rating on the stock. But here you can see it's been underperforming. Look, here's the scooter now down under 30. It was actually under 20 this morning, and you can see that institutions have been selling the stock. So for me, with this uptick back over the 50-day moving average, it was a good opportunity to sell a weak stock that had popped. You can see we've gapped down. Obviously, a lot of volatility there, but again, completely takes the emotions out of it and gives you a directional edge with our power gauge. So I've kind of sat and showed you what you could do within stock charts and how you can replicate a lot of my process. But, as I said, until now, you haven't really had access to the power gauge. But back in February, we rolled out a new product, and Mark has spoken about this as well. I think he spoke about it in February, and it was, we had an influx of orders for this product when Mark was on this show back in February. So a lot of the stockcharts.com users are using our power gauge now with our product called Power Pulse, and it kind of positions your portfolio for success, and it all signals or stems from that power gauge rating. You get 3 powerful investment tools. You can do personalized portfolio monitoring. You load your portfolio in there, whether on your mobile device, your desktop device, or your tablet. You can load your portfolio in there. You can load your watch list into it. I keep 2 watch lists in there, one bullish and one bearish. And when our ratings change, you'll be alerted to that. Here, when very bearish to very bullish and everything in between. The research is done for you. You get the power gauge. The power gauge is taken into account the 20 factors that go into the model and come up with a rating. And our very bullish stocks on average return about 20% a year and outperform the market. And our very bearish stocks, they underperform the market. So you want to be looking for long ideas here and looking for short ideas here, and then using your technical overlay as part of your process to identify when to get in and out of the stock. You can use Scooter, you can use Chaikin Money Flow, or any other indicators that you like to use. I personally also use a 14-period RSI. And in addition to all that, you get every Sunday Mark's weekly market commentary, so you'll have everything you need kind of for the week ahead. I mean, sometimes I write it, which is always a lot of fun. I get to spend the day on Sunday writing it, and then it comes out on Sunday night. And I always look forward to reading Mark's thoughts and ideas and what he has to say on Sunday night in front of the market for the week. Because, like you said, I mean, how many people really get to work with and for a legend? So to have his thoughts and ideas at your disposal, I mean, I don't think I could put a value on that. And so here's just kind of some examples of the ideas from today. Here's Assurant. You can see the bullish power gauge rating. We give you each of the factors that go into that, right? Financials, earnings, technicals, and experts. And you can see what's driving the model. Right now, it's the financials bucket as well as the technicals bucket. Our trend line, here's money flow, and here's relative strength. It's not the full version of what Chaikin Analytics members receive, but a product like this in conjunction with stockcharts.com and your current technical process, I think makes a ton of sense. Here's Tesla. You can see, I mean, red all the way. The stock is under our long-term trend line. And I mean, here's why the stock is very bearish, because the financials are very bearish. The earnings are very bearish. The technicals are neutral, and the expert opinion is very bearish. So when all of that gets rolled up, we have an unemotional look at a stock that is very bifurcating and oftentimes swings violently and evokes a ton of emotion. We take that emotion out of it. So normally Power Pulse is about $50 a month, $49.95 per month. But for stockcharts.com users now, we're taking half off. So for $24.95 a month, you can receive this product to use in conjunction with your technical analysis to really give you that directional edge, to kind of put you in the stocks where you want to be. Very bullish stocks for long ideas, bearish and very bearish stocks for short ideas. And you can sign up by visiting chaikinanalytics.com/stock charts to get that special offer for stockcharts.com users of $24.95. So that's kind of everything I have today. I'd love to stick around for some questions.
All right. We have quite a few in the chat room.
I love it.
Of course, the big one, and of course, they always Well, everybody does. I mean, you're only as good as your last not so good pick. But a lot of people were asking, why was Facebook, looking very bullish and, using the power gauge. I think you guys had that rated very high. So yeah, the question is, why was it high? And then we end up with a crash today. So,
Well, I mean, listen, again, the model is for the most part fundamental. And up until today, the fundamentals on Facebook have been outstanding. I mean, this is a massive stock with a massive revenue base that is still growing big numbers on top of that revenue base. So from a fundamental standpoint, coming into today, I mean, Facebook looked outstanding. What I will tell you is that within Chaikin Analytics and that overbought, oversold indicator that we use, with the move higher in the stock leading into earnings, that indicator actually became massively overbought. So there was a signal there not to get involved in front of the print. But this is the danger of trading in front of earnings. It is a quantitative model, right? And it's not going to get every stock right. If it got every stock right, I mean, we wouldn't be sitting here talking about it, right?
Exactly.
It's just like any other indicator. What it does is put the odds in your favor. When I talk about it with our clients, and I get this question all the time, hey, Dan, you picked XYZ as your stock of the day on Monday, and today it's Wednesday, and it's down 3% from where you said you liked it. What's up? Yeah. And I just tell them, I reiterate my process. And I tell them that my process combined with that power gauge gives you a directional edge. And I hate to make the analogy to a casino because I don't want people to think that investing is gambling, because it's not. But I want you to think of it in terms of the business model of the casino, right? With the exception of poker, every game in the casino is skewed to give the house a slight edge. Not a massive edge, because no one would ever play, but a slight edge. I think in a game like blackjack, the house has a 2% edge, right? So over a million hands of blackjack, the house is going to win 52% of the time. The house is going to lose 48% of the time. But that 2% edge makes them a fortune, right? Played out over millions upon millions of hands of blackjack. So I use that same analogy here. The power gauge gives you the edge. We showed you the statistics, right? 20% a year for very bullish stocks against the average stock over that time frame in the Russell 3000 at about 9%. So, 10% outperformance, 11% annual outperformance. Just by focusing on the very bullish stocks that we rate, you've gotten that edge. Are they all going to go up 20%? Absolutely not. It's an average. Some are going to go up a lot more. Some are going to go up a lot less. But we've basically just given you the 2% edge in blackjack.
Right.
And if you follow the process time and time again and have disciplined risk management, I think that's something that gets shortchanged a lot, especially when people are looking for ideas. What's funny is everyone always asks me, what do you like and where is it going? You know what no one ever asks me? If you're wrong, where is it going and where do you get out? No one ever asks me that question. I actually think that's the more important question.
Yes.
Right. And there are going to be circumstances like Facebook where, even if you were trading Facebook and you were long it and you had a disciplined sell strategy, maybe you have a stop levels that you use and you move that stop over time. Well, the stock gapped down 20% today. It probably gapped through your stop, right? That is, it's an outlier, right? A lot of times, a stock will roll over, trigger your stop, and you could get out if you've been, following the trend. But no one ever talks about that. And when I talk to our clients, I give them the ideas. In my note, I always give them a level where I'm wrong. No one ever asks me about it, which is amazing. But I always, when I put out the trade this morning on AIZ, I said we've broken above $105. I think there's upside to 120. But if we go back below 105, that negates this trade. And no one ever, and so, but basically what I've done is I'm risking $3 to win 12 in a stock that I know is more likely to outperform because it has a bullish rating.
Right.
Sometimes, Erin, sometimes you walk into the casino and you win a hand of blackjack, right? The casino doesn't win all the time, but they have that edge. The power gauge gives you the edge. Your process helps you get in and out, but you still have to manage risk.
Absolutely.
Yeah,
No, like I said, it usually is, your last not so great call. I find that like you're talking about is when you put something out there, it's not an emotional thing as long as you are, pointing out all of the technicals that go behind it to qualify what you're saying. Because,
That's right. And Tesla is a great example of that.
Mhm.
Right. I mean, I don't know if for those of you who are listening, and Tom and Aaron, if you ever go on Twitter, the arguments that people have with each other, people who presumably don't know each other other than on Twitter,
Mhm.
the vehement arguments that people have and how dogmatically they hold their views. And there are people who think that Elon Musk is a complete fraud, and there are people who think that Elon Musk is the next coming of God.
Right.
And those emotions get in your way. I picked Tesla as a short, not because I think Elon Musk is a fraud, not because I hate their cars. I've actually never been in one, but
they're nice.
they do look great. And I know you're in Cali, you probably see a lot of them.
Mhm.
I'm starting to see, I'm in New York and on Long Island, and I'm starting to see more of them. And I'm going to say they look great. I've never been in one. I can't speak to anything other than, seeing them on the road, but the car could be great. The stock could be a disaster.
All right. Well,
our model says it's, likely to underperform.
Right. Let's see. I have a couple more here, and I know we're getting short on time, but one quick one was that when you were looking at the sectors, you didn't have XLB in there. And was there a reason for that?
No, it's actually at the bottom of the list. And one of the things that we're working on, so when I pull up this screen and I take a shot, and I don't know if you can still see my screen.
It's screenshot.
This is a screenshot that I pull from Chaikin Analytics. And what happened is last week we got the new communication services ETF, and that made it so that there's one more here than I can show on the screen, unfortunately. Okay, well, so I'm working with my team. XLB is actually below consumer discretionary.
Let's see, if we could make it real quick. Let me do this one really fast. Does the Power Pulse include ETFs or just stocks?
You can look at ETFs as well. We do not have a ranking system for ETFs yet, though. That's coming in September.
Okay.
So the model that we use to rank stocks, very bullish, neutral, bearish, or very bearish, we are going to be rolling out a rating system for ETFs, and that is going to be really, really exciting. I'm really looking forward to that because we know that there are a lot of people who trade ETFs. We actually get the question all the time, which prompted the development of that product. A rating system for ETFs would be great. Right now, we don't have it, but it is in development, and it should be out in September, and it's going to be super exciting.
Excellent. Well, I know you've got the Power Feed breakfast Monday through Fridays on Stock Charts TV at 9:15.
9:15 we are. Yeah, it's fun. I enjoy doing that as well. And that's really good because I used to run the morning call for an institutional desk.
Mm-hmm.
And so I basically treat Power Feed TV 9:15 every morning the same way I used to treat our morning call. I come on and I talk about the markets, and obviously I don't have fundamental analysts to bring in to give you their pitch on their ideas.
Mm-hmm.
Today I would have had our Facebook analyst come in to talk about, why she was either defending Facebook or downgrading it or what her thoughts were, right, coming out of the print. I don't have that at my disposal, but I have a lot of the same tools that I had then, I have here, and that's what we do. We go through stocks, and instead of having an analyst, I have the power gauge, right, which I prefer because it's unbiased.
Right. I know. I love
it. So for what it's worth, today's stock was Google.
There you are.
As a long idea. And the power gauge is very bullish on Google.
Nice. All right. Well, we enjoyed having you on the show as we
always a pleasure.
It was great. And yes, there's your information there. Go ahead and check out it, Chaikin Analytics. And I'm sure we'll have you back very soon.
Yeah, I would love to come back. I love doing the show. It's always great. And I learn a lot listening to you and Tom as well to kick things off.
Excellent. All right. Well, we will bid you adieu and move into the 10 and 10.
Excellent. Thank you. Have a great day, everyone.
Yeah.
You do as well, Dan. Thanks for coming by.
Thank you for having me.
All right. Okay, since we are starting it just a bit late, I'm going to just hand it right over to you, Tom, for the 10 and 10. And our first one is Williams Sonoma. And I think there was a question about this one yesterday about Wyckoff, and if you had any comments on accumulation and breakout breakdowns.
Well, I can't do this justice, for Bruce. I think that, I know that Bruce was in here talking about Wyckoff this week, and he is the master, and I don't want to take the words out of his mouth. But to me, what it looks like was going on is we did have a period of reaccumulation. And this breakout, I think, was very significant because you can see the volume that was building on the gap up. And then as it made the breakout, you can see the volume was very strong. The problem I had with Williams Sonoma here is that here on the breakout, the last breakout in the third or fourth week of June, you can see that as we went up to new highs in terms of price, the PPO had rolled over. So we were starting to lose momentum. And also on this initial breakout here, toward I guess this would have been the 15th of June and the 18th, I circled the volume. It wasn't bad volume, but it was certainly a lot less than what we had seen before. So I just wondered whether or not maybe we were getting just a little ahead of ourselves in the near term. The stock had run from $47 up to $65 in a month. And when you look back at the sideways consolidation, that was a really big move. So I think the stock is consolidating. In a worst case scenario, I think we go back to $56. I'm not sure we get back that far. I like the fact now that we've got the PPO back down near the center line. We've got a 50-day test. We almost hit that 50-day yesterday. I like Williams Sonoma. I think it's in an area where I could begin accumulating, and I would accumulate it down to 56 and maybe keep a fairly tight stop, maybe use 55 as a closing stop. But I would be looking for another breakout in the days ahead on Williams Sonoma.
All right, excellent. Let's see what our most popular was in the chat room. I'm going to get that. It's always interesting to see where we go. It was a tie between Netflix and Momo, and we looked at Momo like yesterday. So I'm sorry, guys. We'll keep that one out. It came in second anyway. Netflix. We'll go ahead and do that one.
Yeah, Netflix, after gapping down, came right up. And I think I remember talking about this, saying that 380, 385 level was going to be the first key area to get through on Netflix. And now with the declining 20-day moving average sitting at 380, I think it's even more pronounced. So that's an area I think is going to be really important to try to get through. So there was the intraday lows right at about 380 there. Notice when we gapped down below, we came up to 380. And we've started to roll over. And now, as I mentioned, that 20-day moving average, 379.58. I don't know if this is a long-term change in character here on Netflix, but certainly short-term, this was a problem because we did have higher highs in terms of closes with a lower PPO. And then we got the gap down. I really like that huge hollow candle. So I'm going to say this is if Netflix can hold on to 340, maybe just a tad below 340. That was the more or less a double top breakout that we saw at the end of May on increasing volume. I think as long as we hold 340, I'm going to assume that Netflix goes higher, but I wouldn't be surprised to see additional accumulation or consolidation, I should say, over the next several weeks. I would expect that we're going to sit between 340 and 380 for a little bit, and then maybe see Netflix make another run toward to the upside as it nears its next earnings report.
Okay, so let's go ahead and look at specialty chemicals industry, CF Industries, CF.
Yeah, I know this is one I think's been upgraded. I know you've talked about it recently, I think.
Mm-hmm.
The stock on has bounced off its 50-day moving average, turning back higher again. I think it looks pretty good. It continues to put in higher highs and higher lows. The June high here took out the March high. So I think it looks pretty good. I would just say you're getting closer to resistance. And my trading style is short-term in nature. And as I get close to resistance, I tend to sell to see if we can get through, see if we can get the volume breakout. I wouldn't be surprised to see it consolidate for a period of time after this move to the upside. So getting through 46 could be a little bit of a challenge. I'd be a seller until, up in that 45, 46 range until we can get through. I wouldn't be a short seller. That's a difference. If I was long, I would sell to take my profits. But this is a stock that's trending higher. I think looks pretty good. I'm not going to short it, but I think taking profits at this level would not be a bad strategy at all.
All right. Next one up, let's see, Kimco Realty and the retail REITs, KIM.
Yeah, we're starting to get some strength, and we've been getting some strength here recently in financials. And of course, REITs, I know you've mentioned it before. I think Arthur, when he was on the show, talked about REITs and how, they've certainly improved quite a bit on their charts. I like that we're holding on to a trend line just above the 20-day moving average. And the trend line that I'm referring to, and I would continue to watch, is right about here. So as long as we stay, let's call it 1650, as long as we continue to trade and close above 1650, I'm okay. Now, these don't move very fast, so you could even give it a little bit more room. The last reaction low was down here at about 16 off of the high that we saw in the second week of June. We pulled back to 16 before breaking out to 17 and a half. So 16 would give you a little bit more room if you want to give it room. But, we've got a nice trend line in play that comes in just above 1650. Breaking through 1650 would be my first warning sign. $16 would be a problem for me.
Okay. The next one up is this choo-choo ready to leave the station, CSX. That was not me. I'm not that good. Somebody in the chat room did that one.
Yeah, I love railroads. I wrote about them today in my blog. I think the railroads look good. I think what they're telling us is that the U.S. Domestic economy is strong. That would be one reason. The primary reason why railroads would go higher is the anticipation of shipping more goods. So I think the breakout here on CSX, which was accompanied by very strong volume and its earnings, I think is going to lead to higher prices. I don't like to chase, though. I'd like to see it pull back a little bit. I think the rising 20-day moving average, which is currently at 67 and change, coincides with that prior top in the second week of June. If we could get a few dollars back on this stock back to 67 and change, 68, somewhere in that neighborhood, I like CSX for a trade.
Okay. This one's been in quite the downfall. Tailored Brands, TLRD. It may be hitting some support, and the PMO is trying to curve, but this is a falling knife, in my opinion.
Yeah, I would be really careful. There were multiple tests of support at about 20 or 20 and a half. So here we'd moved up, consolidated, and then we broke out. We came down and tested this 20 and a half level back in January. We did it again in February. We almost got there in March, and now we're moving down again. I'm going to assume that it holds, but I'm also going to be somewhat cautious because this looks like a change in character potentially. We had a nice uptrend in play, and then this huge gap down on massive volume. And notice we haven't even been able to touch that 20-day moving average on any strength. So the stock looks very weak, but we have support coming up. It's not my style to try and catch this bottom here, but if I was in it, I would watch very closely. A close below $20, I think, would be very bearish.
Okay, and as I always say for our Canadian friends, this is Consumer Staples. It's ATD, as in Delta, /B.TO. And I see like a huge, like a large cup and a handle right now, but my PMO is so ugly. I wouldn't even.
Yeah, I like it. I like it off the 20-day moving average. I love this gap up on the heavy volume. So I would be okay with it. The only problem I have with it, calling it a cup, would be it should come off of an uptrend. So that would have to start the cup way over here in December. Mm-hmm. It's really kind of discombobulated cup. So I probably wouldn't play that. But I would like, I do like the fact that it had some, after the big gap up on earnings, it came down to about 59 and a quarter or so. And that has been holding along with the 20-day moving average, 59 and a half. This stock was 63 and change less than 2 weeks ago. Now you're getting it on sale a little below 60. This is my style. I actually like the stock here. I would be looking for a return to 63.
All right. Our styles are different, which is why everybody likes to hear us, I think. This one's looking pretty good, but I wouldn't chase it. Marathon, MPC.
I believe that was earnings related. I'm pretty sure that MPC came out with a nice earnings report. I think we could have an inverse head and shoulder developing. So you've got a neckline. So you got to start with a high. Here's the left shoulder. Then you got this neckline that starts over here. Looks like it probably comes in at about 82.5. So you got left shoulder, left side of the neckline, go down to a head, which is slightly below the left shoulder. Now you're coming back up, volume's picking back up on the right side. I think you could see the right side of the neckline form and another pullback. I'm going to say the top of gap support, 76 or so, would be an interesting area for entry on MPC on a pullback. I agree with you. I wouldn't chase it, but I do think a pullback would look pretty interesting on MPC.
Okay, let's see. Let's look at MyTech Systems software, since we already looked at Momo, so I figured we'd pick another software, MITK.
Yeah, it's making a breakout. Light volume, though, so we're not really getting a good move here. I'm going to pull this one up on the relative chart to see what it looks like. Which group? Oh, it's in software. I mean, you can see this is a stock that hasn't taken out the highs from a year ago. Look what the software index has done. So what does that mean? It means MyTech on a relative basis has been a pretty strong underperformer. This is not the way I want to fill up my portfolio. So I'm going to pass on it just because in software, if I want a software stock, there's so many others out there right now that I think are trading much better than MyTech. I think for me, what I would highlight here in annotating would be this relative weakness. This is what bothers me. So even though the stock's going up, I think it's going up less than the overall group. So I'd look elsewhere.
Okay, and our final one, I'm not sure what I would do with this one. It just, to me, has a look of a descending triangle, but I don't know. Neptune Technologies, NEPT. PMO's turning up, but
let's see. Well, it is turning at gap support. Look at the volume that came in here on this move to the upside. Here we held the top of gap support. I think this is actually perhaps a little bit of a accumulation going down here below this 280 level, putting in a couple of tails here. And now it looks like it's trying to turn back up. The problem is the stock has already risen off the recent lows 20% at today's high. So it'd be nicer to get it a little bit cheaper. But ultimately, I wouldn't be shocked to see the stock move back up to that 440 level. And what I was talking about here, there's your gap up. Look at the volume. The gap up to about 288 or so. And then we're at 440 next, 2 days later, 445. Pulled all the way back down, top of gap support, made a nice bounce. And here's where it got a little tricky as we move back down. But notice the volume was light and the hammer printed, and now we're starting to move higher. I think the closer you get this down to 285, the better I like it. I even like it around 3%, or excuse me, $3, using that 445 as ultimately as a target. It is a small company, so you got to be prepared for some volatility here. But I like what's going on now. I'd probably research and find out if that was earnings related. If it's a buyout rumor or something like that, I'd probably be less impressed. But if it was earnings related, I'd be much more impressed.
All right. And that concludes the 10 and 10. Here are the symbols that we did go over. I will have these up in the Market Watchers Live chart list with all those annotations and that relative chart. So if you want to go take a look, go to the Market Watchers Live blog and you'll see the chart list link at the very top. All right, well, we will be right back with the final market update after this message.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.
All right, here's our final market update for Market Watchers Live. Markets are really moving in very different directions right now. We can see the Dow is up, but consolidating sideways, up just over 100 points. However, the S&P 500, the NASDAQ, and the NASDAQ 100 all in the negative right now, but we do see mid caps and small caps. They did have a nice run this morning, but they are pulling back. Still in the positive though for both the S&P 400 and the Russell 2000. Canadian markets, though they opened lower, have now gotten back to the positive side, could be forming an intraday flag. Treasury yields are up right now, currently reading at 2.97%. UUP, big gap up, still managing to move higher, but getting a little volatile here at the top of the range for the day. Gold, big gap down and consolidating sideways. Looks like a symmetrical triangle, which could be a problem because they are continuation patterns and we could see gold fall further. USO and oil is up. USO reading at 1448 currently. And the volatility index, when we looked at it earlier today, Tom, it was much lower. We're seeing it rise now. It's at about 12.5. And let me take a peek here for you at my short-term indicators. I wanted to point out the fact that yesterday when we got our breadth readings, that we did get what I would call climactic upside readings on breadth. And I look at these as either sentiment or, I look as to whether it's an initiation or an exhaustion. And right now, even though we had already moved up twice here in this rally, I was looking at this as more likely a buying initiation, that we would see higher prices over the next day or two. We'll have to see if we can overcome some of the difficulties we're having today with this bifurcated market. But at this point, I would still consider this a possible buying initiation. But based on action today, it looks like it could end up being buying exhaustion. And that completes our final market update. We have an interesting segment up for you next, and we call it Watchlist. So, Tom, I know what we generally do is go over what's currently sitting in our watch list. I thought I would go through what has been in my watch list. I did drop one from my watch list from before, and I did add 3 new ones. So I thought I would just start that off if that is good with you.
Go right ahead.
All righty. So this is currently what watch list I'm looking at. I'm going to show you the first very quickly, the 6 that were in my list last time we had our segment, and what's going on with them now. Now I've had 1-800-Flowers on my list for quite a while. I do believe I wrote about this one in one of the chart watchers, or we talked about it here when I added it to my watch list. I was looking for a breakout from this trading range. We got the breakout. It didn't come on the PMO bottom. We had seen a flat PMO bottom there. It hadn't quite bottomed yet. And then we got that big upside move and it did break out, which yanked that PMO higher and into a buy signal. I thought that could be an interesting entry, but I wanted to wait to see if either one, it would pull back to that breakout point or not. It did pull back, but it didn't close further down. It still managed to continue higher. But I think this one was a good one to add after that breakout. I didn't add these to my portfolio. These are watch lists. So I just wanted to show you what I was thinking about when they were on it. And this one I thought was very interesting. We got that buy signal on the PMO long before this big move up. And we're just about at overhead resistance already on this move. And of course, like we were just talking about, chasing stocks. But gosh, looking at this PMO and the signals tend to be very clean, meaning there isn't a lot of typical, like you can see back here, that's not very clean, kind of a noisy PMO while it was flattening. But when you get these really clean signals to the upside, and that is accompanied by the volume and scooter, I think this one's still pretty good, but I would continue to have it on the watch list because I would be waiting for that pullback. AXTA, currently still on my watch list. We do have the PMO buy signal. You can see that we attempted a few, but now we're finally actually getting the buy signal. You can see a short-term pop above that very short-term previous top that we saw earlier, looks like about a week and a half ago. And we're getting ready to test this overhead resistance that we're seeing here. The only caution I have with it is, OBV hasn't been reacting the way I would want it to. So even though we're getting a little bit of a short-term breakout, the 50 is below the 200, price is below the 200, I still think this could be an interesting play. And honestly, the risk-reward setup here isn't too bad when you look at the bottom of that trading range and the possibilities to the upside. Let's see, I was going to go over Mazor Robotics. And this one I know I've been talking about. I feel like I picked it for one of the Monday setups. I've been watching this one closely, and we finally got the breakout on this PMO buy signal after some consolidation. I think this one is a good one to take off the watch list and get into and move to the portfolio chart list. So I'm liking Mazor Robotics right now based on what I'm seeing here with the accumulation, the nice OBV and PMO. NVIDIA was on my watch list, continues to be. Waiting for, I got the PMO buy signal. If I recall, it came on the watch list right after that PMO bottom. And then we saw what I don't like to see in a thumbnail is, a horn shape. Gosh, my head is, I'm trying to remember, it's expanding pattern. I don't like to see that. It shows increasing volatility. So it's still on the watch list, but we're now seeing a bit of a breakout from that little bit of a trading range we saw, that consolidation zone. So this could be a possible play at this point. You've got a PMO buy signal that it's in oversold territory. So I think NVIDIA looks rather tasty. All right, I dumped GE from my watch list. It's just faked me out way too many times. My dad got in. I think, I don't know if he's still in. He usually holds for quite a while. But I told him when he did it, I said, good luck. I've played this thing to death. And, I decided I'm taking it off the watch list. I got a PMO sell signal. I'm just tired of trying to call that one. So I took it off. Here are the three that I did add, though. One is DVY, which is the iShares Select Dividend ETF. And I have it on the watch list, but in all honesty, it is also in my portfolio. I got this one, oh gosh, I can't even say how long ago with the buy and hold. Let me try and get this to a good chart. Here we go, so everybody can see it. So I've been continuing to hold it. Yeah, I got killed here on that lovely pullback, but it has done really well for me. I like the dividend paying stocks, and now I added it because we got that breakout from that declining tops trend line, and so I see some opportunity here on that breakout. But again, whenever I see a breakout, I do like to see a little bit of a pullback toward the breakout point. You're going to typically see that. I would like to see that, but at the same time, I think you could get in, set up your stop around 98. I would certainly plan for it to reach, if not pass, that January high, that January top. And I like this rising PMO bottoms just slightly in confirmation. I think it looks pretty good here. You can even see these PMO tops were mostly flat. So I'm not too concerned about negative divergence there. So I think DVY is a good looking one I added. Nike is the other, and I'm going to move this into. All right. We tried to close that gap, did not quite do it, but now we're starting to see a bit of a breakout here from that declining tops. You can see in the thumbnail, the PMO is now turning up. This is a bounce to me off of kind of a support area of those tops. It did go a little bit below it, but you've got the 50-day EMA. It held up as support. It's already in a strong scooter. And OBV is reacting as I'd want it to. So I think this one might be, I think Nike might be in a good place to go ahead and add that to the watch list, which is why I did. And Philip Morris, I think Dan talked about Philip Morris, and I think he was on my side as well, that this looks like a really interesting buy play. I just got an intermediate term trend model buy signal when the 20 crossed above the 50. Yes, the PMO is in near term overbought territory, but if we look at this on a very long-term basis, and I'll just add 4 years, you're going to see that it's really, that PMO is not overbought at all. We still have plenty of upside space. I would be looking at this possible reverse head and shoulders and a breakout. I like Philip Morris right now. And those were the ones that I had for my watch list. What do you have for us, Tom?
All right, let's take a look at a few stocks here. First, I'm going to go over the Disney, DIS. Talked about this one earlier in the show. And I'm going to look at these on I'm going to pull them all up on my relative chart so we can get a better sense of how they're performing relative to their peers and so forth. Here's the broadcasting and entertainment group. You can see nowhere near the high that we saw back in January, yet Disney's breaking out. So on a relative basis, what you've got is a stock that's breaking out relative to its group. Look at the volume coming in on the push to the upside. I really like this breakout on Disney. I think the stock goes higher. I know earlier 3D Systems you were looking at, you weren't a big fan. And the overall group, hardware group, is breaking out to new highs. And while this one has been moving lower, resulting in not so great relative strength here in July, I do like the fact that it is trying to hold on to the support. We had a double top that came in around 13. We put a tail all the way down today to 1243, and we've come back up now trading at 1335. Looks to me like maybe that's some accumulation here at support. So I think there's a chance maybe DDD, 3D Systems, bottoms and makes another run for that 16 level. Qualcomm, this one is one of my favorites. I bought this one today. Qualcomm, I think, number one, I've talked about this one recently. Qualcomm loves historically, seasonally, the second half of the year. I'll pull the seasonality up in just a minute. But you've got a stock that it's in a pretty decent industry group. It has started to show some relative strength here as we've gotten closer and closer to the midpoint of the year. We're now starting to see strength. Qualcomm came out with the earnings today. They beat top line, they beat bottom line, and what was most impressive about their report is that they announced that they're not going to acquire NXP semiconductor. And instead, what they said they're going to do is put that money toward a massive buyback. This company has a market cap of $92 billion. They announced a $30 billion buyback program, stock repurchase plan. That's 1/3 of the market value of the company. That's one of the largest, if not the largest, buybacks I've ever heard announced. Shows a lot of confidence in the company. And the fact that we are now in the second half, let me pull this up for you real quick. We're in the second half of the year where, if I go back 20 years, check out the returns. Here in the first half of the year, outside of March, which obviously is a very strong month, starting in July, Qualcomm averages, these are monthly returns, average monthly returns over the last 20 years, 4.7% in July, 1.3% in August, 0.6% in September, 2.4% in October, 8.4% in November, and 5.3% in December. I think when I added these up, in the first 6 months of the year, Qualcomm average is going up about 4%. Second half of the year, average is going up 22% over the last 20 years. So I think Qualcomm, based on the chart, based on that buyback, based on the technicals, the earnings, everything, and seasonality, I think that is a very strong candidate. PVG, and these last handful, I'm going to just do quickly. Now, this is a mining stock. Some of you might be ready to fall off your chair because I'm talking about a mining stock bullishly, but I would have a very tight stop. We gapped up on very heavy volume, went back down, hit the 20-day and gap support, starting to turn back higher. As long as we hold on to this $8 level, I'm okay with it. But I'm not a huge fan of the group, so I would keep a tight leash. ARCB in the trucking space, truckers back in June broke out. I think transportation still looks good longer term. This one's been consolidating since a huge move up back in May. I think it's going to regain that strength. I'd be keeping this one on a watch list. MMSI, this was a Monday setup of mine a few weeks ago, probably about 6-7 weeks ago. Came back down to this price support level here at 48. Stock made a huge run into earnings. It gapped up, and then after gapping up, announced a secondary offering and priced it at $54 a share. So the stock's come back. Fundamentals here, though, are great. I expect we're going to get another run above 60 on MMSI. MNRO, this is in the Specialized Consumer Services group, and check out this group breaking out. MNRO also broke out on great volume, and it's pulled back to gap support and price support and the rising 20-day moving average. I think this is a nice reward to risk entry. And the last one I have is Ryder. Big breakout yesterday above multiple tops at $76. Volume expanded. It is, in that transportation services group, which has not been particularly strong, but over the past 2 months, you can see the relative strength really building in Ryder. So I think a pullback to 76 would look interesting. So let's summarize our watch list selections for this Thursday. And you've got Aaron and my picks looking at some of the stocks that at least we're keeping our eyes on technically. A number to choose from for sure.
Absolutely. Hang on, I got to pick myself off the floor from you recommending a mining stock. Let me just get
no recommendation. I don't make recommendations. I'm not a registered investment advisor, so I can't.
There you go. That is true. So
Yeah.
you were watching.
Yes, these are ones I'm watching. This, it's all educational. That's why I hope everybody takes this, because obviously we have no idea what everyone's personal financial situation is. So I would hate to try to recommend for anyone what you should buy or not buy.
Yeah, that's why those disclaimers exist. Hey, we did ask on the poll what people are thinking about Facebook, if it's a bottom feeding opportunity. And I thought it was pretty interesting because I'm looking at it right now, and half of you just say it is going to be one because not now. And then a quarter, not on my radar. And yes, so I was in the not now category. I don't know about you.
I do not like Facebook at all. One thing I've learned over my years in the stock market is that when you drop a bomb on Wall Street, Facebook was at its all-time high and traded 65 million shares yesterday as it went higher into its earnings report. There were a lot of folks on board. I think they dropped a bomb on analysts. They dropped a bomb on everyone. The two stocks that I showed earlier in the program, the two worst performers in the S&P 500, Facebook was one. And Facebook looked great going into its earnings. The other one was Nielsen, NLSN, and that one had been downtrending for many, many months before they dropped their bomb today.
Yeah.
Big difference. I think you lose trust on Wall Street, and it takes a long time to regain it. Now, maybe because of Facebook's clout, maybe they'll get it back quicker than some companies, but I have found in the past that when you all of a sudden drop a bomb, it can take a long time to get Wall Street to trust you.
Can you say GE?
Yeah, that would be one. But yeah, I think you're going to see a lot of downgrades in the days to come. I think this stock is not done going lower. I think we're going to see that 150 low from back in March tested before this is all done.
Yeah, interesting. Yeah, I'm going to keep it on my radar still. I'm not ready to take it off. All right, upcoming schedules here for you. Just to remember, we had Dan Russo on, and his show is going to run Monday through Fridays, Power Feed Breakfast later today. Here's what we've got coming up. And for live show, the Final Bar with Greg is going to be live at 5 p.m. Eastern.
Sounds good. Want to thank everybody for joining us today. Please remember to complete the survey as you exit. We do love to get that feedback. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Thursday afternoon, everybody. Hopefully we'll see you back here on Friday. Happy trading.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.